Okay, peeps, welcome back. So today we're going to talk about how to retire with the Grayscale trusts, and once you cash out, where to invest the profits. So with that being said, let's get it. So what do I mean by retire? Well, basically, it kind of depends on how much money you make in the Grayscale trust. We're going to go through some hypothetical numbers here and where you could potentially put the money going into the next crypto bear market for safekeeping until the bottom of the bear market. I'm sure Ethan has over at Ethan, who talks about the Grayscale Trust. He's probably talked about this too: rotation of capital in between crypto and dividend-paying stocks, whether we're in a bull market or bear market. But the idea here is to move money out of crypto into safer assets that are not going to go down 80 to 90% like crypto would. And when I say safer, I mean something like maybe options and or stable NAV dividend paying stocks and or ETFs. So kind of the basic thesis here is from the start of the crypto bull market or the bottom of the crypto bear market, the idea is to invest into crypto and then cash out, basically do that until the peak of the bull run or as close to the peak as we can get, cash out, pull that money out of the market, and then turn around and move it into something else that can continue to grow over time until the bear market bottom hits, and then start moving either some or all of that money back into crypto at the bottom of the bear market in crypto. So let's go ahead and go over some of those numbers. So we're just going to assume that we'll take three hypothetical numbers here. Okay, we're going to take 100,000, 200,000, and 500,000. Now I know a lot of you guys out there probably are going to make a lot more money than that. Hey, hats off to you, man. If you can make 5 or 10 million bucks on this sucker, congrats, dude. You do you. Get that mansion, get that Lambo, whatever it is you're after. Not financial advice. I'm just saying if you got the money, that's what you want. Hey, do it. So we're going to take more conservative numbers, just a starting point that I think probably most people can achieve if they set their mind and, follow through with actions on it. So we'll start. And by the way, this is after tax money. Okay. This is not before taxes. So running those simple numbers, if you had to pay 20% on 100,000, that'd be about 120,000 before taxes. If you had to pay, let's say 25% on 200,000, you're probably going to talk about 50,000 in taxes. So you need to make about $250,000 before taxes, and 500,000, you're pretty much almost guaranteed at that point to pay the top tax bracket, which is like 37%. So if we do times 0.37, so you basically need to add that 185,000 on top of 500K. So you would need to make roughly about 700,000. So this is after tax money. So we're going to do a 50-50 split. We'll do 50% in options, 50% in dividend paying stocks. Now, why do I choose options? Well, I'm sure a lot of you guys follow a lot of people out there that invest in dividend paying stocks that also do options. We also do options. We don't have that much money in options right now, but we still are going to manage to pull in probably at least somewhere between $1,000 to $1,200 this month, and it is with way less capital invested than what we're talking about right now. So let's start with the options. Okay, we're just going to use one stock in this video as an example, which is a relatively stable stock. I mean, it got a lot of government contracts and a lot of adoption by the public and the markets and whatnot. So overall, a pretty good stock. Actually, I'm not even sure if this is the entire market history of this thing. So let's go over to the charts on TradingView. So as you guys can see, well, of course, with the exception of the 2022 bear market, because pretty much everything got killed during that market. But as you guys can see before that, and even after that, the stock has been a very good stock to invest in, from the low at $6 to the high. If you had got the bear market low at this point, you'd be up almost 500%. So that's really good for a stock. And like I said, it has a lot of adoption and government contracts and stuff like that. So we'll use this as an example. So we're going to go over to the options chain. If we were implementing the wheel strategy, which is something we're currently doing, we've already gone over this. Basically, you would need to have whatever the capital is required to buy 100 shares of any given stock, set aside in cash for the cash secured puts, and then that would begin the wheel strategy. So we'd start with a sell put, and then we'd move into a covered call, which is also known as a sell call. And then, of course, the shares would get called away, and then you'd have the money on hand, and then you could rinse and repeat with another cash secured put. If you guys don't know what the wheel strategy is, in short, that's what it is. You can go look it up on your own time. But for simplicity's sake, let's just say that you didn't really want to spend a lot of time maintaining this. You just want to basically write one option a month. That's all you want to do, because you want to have a life. You want to go have some free time and whatnot. You don't want to be looking at the charts 24/7 like we do. It is exhausting, I'm not going to lie. So we'll just keep it very simple here. So this is Palantir. Now, in order to be sure that there is a small likelihood that you're actually going to get the shares called away, I would say anything from a 75% chance of profit or greater is basically a good idea. So what you're really looking for here is a delta of probably somewhere between 0.2 to 0.25, but not greater than that, for either a sell call or a sell put. So basically the inverse of that is 75% chance of profit or higher. So we're going to take the numbers here. So we'll do 50,000. And again, when you do a cash secured put, it's going to basically be whatever the strike price is times 100 shares. So in this particular instance, it would be $20 times 100, so $2,000. So we'll divide 50,000 by 2,000. Okay. So 25, and you can only buy it in hundreds of lots of hundreds. So let's see what this is. 2,500 times 20. So yeah, you'd be able to get 25 lots, I believe. Let me double check this math, make sure it's right. Yeah, so 25 lots of cash secured puts. So basically, this is the credit you would get to begin the wheel strategy per lot. Okay, and since you'd be putting half of that 100K in here, you'd basically take the credit that you would get for 1 month times 25 lots. So this is the amount of options premium you would get for the month on just half of 100,000, and this is just from options. So now we're going to take a look at some of the potential ETFs you could put this money into. The other half, that would also produce a pretty significant income, which you could then, of course, retire on. So we'll do 50K. One that we like a lot is actually YMAX, and we'll show you in the charts, because the NAV of the ETF has gone up over time, which is a good sign. That's what we want to see. We want to see it go up and or sideways. We don't want to see a whole lot of down action. That's for more certainty that it's going to grow with time, right? And your net assets are not just going to erode away because there's too high of a yield and or the stock is going down, which is not a bad thing. Of course, it depends on what you're buying these particular funds for. So anyways, 50,000 divided by the current price here. So current price we'll just say is 21.30. Keep it simple. So divided by 21.30. We get you about 2,300 shares, 2,350 shares. So times that by 0.56, which would give you about $1,300 a month. So if we add these two together, you'd be looking, whoops, my bad. So 1,850 plus, we'll just say 1,315. If you add these two together, you'd be looking at just over $3,000 a month of passive income. And this is with just 100K. Okay, if you're talking like huge numbers, like whale size numbers, obviously it would be much larger than this. So that's one example. For the next example, we'll use the Rex Fang as the next one, and then SPYI following that. So now we're going to go with the 200K. So we'll basically do, once again, 50-50 split. So it'd be 100K per market. So 100K in options, 100K in dividend paying stocks. How you guys want to do this is up to you. If you don't want to do the options, that's your choice. We're just showing it to you as a possibility. So we'll do the exact same strike price, exact same amount of options premium, basically 1 month out, as you guys can see here. So that way it requires minimal effort. You just basically can look at it from day to day or once every couple of days or something like that, just to check on it, but it's not very time intensive. So basically 100,000 divided by 2,000, which is what would be required per lot to buy these. So you get 50 lots. So it'd be $74 in premium times 50 lots. You'd be looking at $3,700 a month in options premium. So now if we go over to FEPI, let's actually, pretty sure we got it here somewhere. Okay. Well, it's in there somewhere. I don't know where it is, but we're just going to type it in. So FEPI, this thing is pretty much roughly around $55. We'll just call it $55. So again, 100K divided by $55, you'd get roughly about 1,820 shares. We times that, times that by the current dividend payout, which again, these are all monthly paying dividend stocks and or ETFs. You get $2,163 a month of passive income. So if we add the two together, it'd be $5,863 a month. So we're going to go over one more example. This time we're going to go with the biggest number that we've talked about so far in the Grayscale Trust, which is the $500,000 mark. So it'd be $250,000 per position, or basically per market. So 250K divided by 2,000 for one lot. You'd be looking at 125 contracts, or sell puts and or covered calls, whichever makes the most sense at the time, in Palantir. So 125 times 0.74. And keep in mind the strike prices and the premium payouts and all that stuff, that's subject to market volatility and implied volatility, and whether the stock moves up or down, whether the VIX is moving up or down. There's a lot of things that go into play on that. Okay, that's not right. So yeah, it's 74 cents per share. It's actually $74 per contract. So this is what you would get per month. It would be $9,250 a month. So the last one we're going to look at here is SPYI. So this is the NEOS ETF. As you guys can see, it's been kind of all over the place, but the idea here is that the ETF is either going up over time or it is remaining relatively flat. A lot of people actually invest into this one right here, which is JEPQ. This one, as you guys can see, is going up, very similar to FEPI and also WiMAX. That's kind of what you want to look for. But SPYI also offers a much higher yield, so that's something to keep in mind. So anyways, it's $50. So we'll do the math on this. 250 divided by 50 would get you roughly about 5,000 shares. And if we take the most recent dividend payout, which was pretty much 50 cents flat, so times that times 0.5, you'd be looking at $2,500 a month. So if we add these two together, it could be almost 12K a month. So that's pretty good money just for cashing out of the Grayscale Trust. Now, if you have Grayscale, Bitcoin miners, and native crypto on top of that, and you have huge amounts, well, the sky's the limit. There's no telling how much you can make. Now, the reason why we picked these three particular ETFs is because they're very heavily diversified, okay? So the WiMAX ETF has I think 18 or 19 different ETFs within it. So very, very heavy diversification on this one. The FANG shares are Rex FANG shares FEPI ETF, I believe, if I'm not mistaken, I think this actually has 30 holdings within it. Oh, no, my bad. 15. Okay. I don't know why I thought it was 30, but it has 15. A lot of big, mega cap, large tech companies in here. As you guys can see, the Mag 7 plus a few others like Salesforce, Adobe, Micron. That's a big name company. That's a semiconductor manufacturer. Broadcom. That's another big one. So very heavily diversified ETFs here. That's the reason why we chose these. And of course, SPYI is the S&P 500, which again has 500 companies. So a lot of diversification and or safety, so to speak. I mean, the last thing anybody wants is to, make all this money in the Grayscale Trust and then turn around and put it into something that's just going to dump before we even get to the bear market. That's not what anybody wants. So we're picking something that's relatively safe. Now, if we were to make these kinds of money, which we probably are, we're probably going to by the end of the cycle, are we going to put them into just these three funds? No. Most likely, depending on how much it is, we're probably going to split it somewhere between 30 to 50 different total positions, which could include single stocks, dividend growth stocks, dividend income stocks, and or ETFs of some kind, because it's just better to be more diversified. It's smarter in case there is some kind of major, economic crash or something like that, a bear market, anything's possible, flash crash, black swan event, you name it. So the more diversification, the better. And of course, there will also be the options premiums, which could be collected as well, and to give you guys a little bit of experience in options if that's something you want to do. This is something we plan on doing long term as we get a larger position in our swing trading portfolio. We're basically going to have not just one stock, but probably like 10 to 20 different positions that we do the wheel strategy on simultaneously, which is a lot again, but it's good to be diversified for safety, which we'll then use to basically churn out options premiums from within the options market. So anyways, this is our video on how to retire with the Grayscale Trust and what to do with the profits afterwards before the bottom of the crypto bear market. Hope you all enjoyed this content. Please like, comment, and subscribe, and we will see you all later. Peace.